Something strange is happening to the Canadian dollar, and most people aren't paying attention. There are no emergency press conferences, no dramatic headlines screaming collapse, no official announcement saying something is wrong. Yet quietly, slowly, almost invisibly, the value of the loonie is slipping away. Not crashing overnight, not exploding into chaos, but eroding week by week, year by year. And that kind of collapse is actually more dangerous because when it's silent, people don't react until it's too late. Today's video isn't about panic, it's about awareness. Because this time, the forces pushing the Canadian dollar down are deeper, more structural, and far harder to reverse than anything Canada has faced before. Imagine waking up one day and realizing your savings don't buy what they used to. Groceries cost more. Gas feels heavier on your wallet. Traveling outside Canada suddenly feels expensive. Imports quietly creep up in price, while wages stay almost the same. No single moment caused it, no single policy triggered it, but somehow your purchasing power just faded. That's how currency decline really hits people. Not with a bang, but with a slow squeeze. And if you think this doesn't matter because Canada is a strong, developed country, that belief itself might be the biggest risk. Before we go deeper, if you value calm, no hype analysis about Canada's economy and global financial shifts, take 1 second to like this video and subscribe to the channel. It helps this content reach more Canadians who deserve to understand what's really happening beneath the surface. This is Canada Global Economics Now, and here we focus on signals most people ignore until they become unavoidable. For decades, Canadians have been told that the loonie is stable, resilient, and protected by strong institutions. And to be fair, that belief wasn't wrong in the past. Canada benefited from a powerful mix of natural resources, close trade ties with the United States, a trusted banking system, and a reputation for fiscal responsibility. When global crises hit, Canada often looked like the safe, boring place to park money. But the world that rewarded that model is changing fast, and the policies, habits, and assumptions that once supported the Canadian dollar are now quietly working against it. And one of the biggest misunderstandings about currency is the idea that value only changes during crises. In reality, currencies weaken most often during periods that feel normal, when inflation becomes accepted, when deficits become routine, when debt stops feeling urgent, when productivity stalls but spending keeps rising. That's when the damage compounds silently. And right now, Canada is ticking many of those boxes at the same time. Let's talk about inflation, because this is where many people stop thinking deeper. Yes, inflation has cooled from its peak. Yes, the official numbers show some relief. But inflation doesn't need to be extreme to hurt a currency. What matters is persistence. Canada is dealing with a cost structure that is permanently higher than it was just a few years ago. Housing, food, insurance, utilities, taxes. These aren't coming back down in a meaningful way. When inflation stays elevated longer than wages and productivity, the currency absorbs the shock. It loses purchasing power internally, and investors notice that externally. Now layer on interest rates. Canada followed global central banks into aggressive rate hikes to fight inflation. That worked partially, but it created a new problem. Canadian households are among the most indebted in the developed world, especially when it comes to mortgages. High rates don't just slow inflation, they also choke growth. When growth weakens while debt remains high, a country's currency loses appeal. Investors don't just look at rates, they look at sustainability. And Canada's balance between rates, debt, and growth is starting to look fragile. But here's where this time is different really begins to show. Canada's economy has become heavily dependent on a few pillars: real estate, government spending, and commodities. Real estate isn't just a housing issue anymore. It's a national economic engine. Construction, banking, consumer confidence, immigration policy, all of it ties back to property values staying high. The problem is that an economy built on asset inflation rather than productivity eventually runs out of momentum. When that happens, currencies feel the pressure first. At the same time, government spending has exploded. Deficits that were once described as temporary are now structural. Emergency spending never fully reversed. Programs stacked on top of programs. And while government support can stabilize short-term shocks, it doesn't create long-term currency strength. In fact, when markets sense that growth relies more on borrowing than output, confidence weakens. A currency is ultimately a reflection of trust. Trust in future value, trust in discipline, trust in economic direction. Commodities have long been Canada's safety net. Oil, gas, minerals, timber, these exports helped balance trade and support the loonie. But even here, the landscape is shifting. Global energy markets are more volatile. Political pressure around fossil fuels creates uncertainty. Investment hesitates when policy signals feel conflicted. And while Canada has resources, getting them to market efficiently is harder than it used to be. Delays, regulations, and global competition all matter. When commodity revenues become unpredictable, the currency tied to them becomes vulnerable. Another silent force dragging on the Canadian dollar is productivity, or more accurately, the lack of it. Productivity growth in Canada has lagged behind peer countries for years. That means the economy is not producing significantly more value per worker over time. Wages can't rise sustainably without productivity. Profits stagnate. Investment flows elsewhere. And currencies of low productivity economies tend to weaken slowly, not dramatically, but persistently. Now add immigration into the picture. Immigration is essential for Canada's long-term demographics and labor force. But when population growth outpaces infrastructure, housing supply, and productivity gains, it creates inflationary pressure without corresponding economic strength. That imbalance doesn't strengthen a currency, it dilutes it. More people competing for the same limited supply raises costs, not output. And again, the currency absorbs that tension quietly. You might be wondering, why hasn't the loonie collapsed already if all this is true? The answer is simple: comparison. Currencies don't move in isolation. The Canadian dollar has benefited from weakness elsewhere, especially during global uncertainty, but that buffer is shrinking. As other countries adapt, restructure, and tighten discipline, Canada risks standing still. And in global markets, standing still is the same as moving backward. The relationship with the United States is also changing. Canada has long relied on the U.S. as its economic anchor, but the U.S. economy is increasingly driven by technology, capital markets, and aggressive industrial policy. Capital flows toward growth and innovation. When investors compare returns, the US dollar naturally attracts more demand. That relative gap puts pressure on the loonie, even if Canada avoids outright crisis. What makes this moment especially dangerous is complacency. There's a belief that Canada will always be fine, that serious currency problems happen elsewhere. History doesn't support that confidence. Many advanced economies experience There's a belief that Canada will always be fine, that serious currency problems happen elsewhere. History doesn't support that confidence. Many advanced economies experienced long, quiet currency declines without dramatic headlines. Their citizens adjusted slowly, accepting smaller lifestyles, higher costs, and lower global influence, often without realizing what they lost until decades later. This is not about fear. It's about understanding direction. A currency doesn't need to collapse to change your life. A 20 or 30% decline over several years reshapes everything from retirement plans to travel, from business costs to national confidence. And once trust erodes, rebuilding it takes far longer than losing it. As we continue this series, we'll connect these forces together and show how they interact in ways most mainstream discussions never explain. Because the Canadian dollar isn't weakening for one reason. It's weakening because many small pressures are aligning at the same time, reinforcing each other quietly. If you're still watching, that tells me you care about understanding what's really happening beneath the surface. And that's exactly why this channel exists. Canada, Global Economics Now, is about connecting dots before they become headlines. In the next part, we'll go deeper into how global capital flows, currency perception, and policy decisions are locking Canada into a difficult position, and why reversing this trend is much harder than politicians admit. For now, take a moment to reflect on how often you hear honest conversations about currency in Canada, not inflation, not housing prices, not interest rates alone, but the value of the dollar itself. That silence is part of the story. And it's exactly why this collapse feels invisible until it isn't. When we talk about the Canadian dollar, most discussions stay on the surface. People hear about inflation, interest rates, or oil prices, and assume that explains everything. But currencies don't move only on numbers. They move on perception, confidence, and global positioning. And this is where the Canadian dollar is quietly losing ground. Not because of one bad decision, but because Canada's story in the global economy is becoming less clear, less compelling, and less competitive at the exact moment the world is becoming more ruthless. Global capital is always searching for three things: safety, growth, and returns. For a long time, Canada scored well on safety. Stable politics, predictable institutions, and a calm banking system made the loonie feel reliable. But safety alone is no longer enough. Investors want momentum. They want innovation. They want productivity growth. And increasingly, they want countries that can move fast in a fragmented, competitive world. Canada, unfortunately, is starting to look slow. Look at where global money is flowing. It's moving toward countries that dominate technology, advanced manufacturing, energy security, and strategic supply chains. The United States is pouring money into domestic industry. Asia is racing ahead in infrastructure and exports. Even parts of Europe are restructuring aggressively. Canada, meanwhile, feels stuck in policy debates, regulatory bottlenecks, and political caution. When capital senses hesitation, it doesn't wait. It leaves quietly. And when capital leaves, currencies weaken. Another critical issue is trade balance. Canada depends heavily on imports for consumer goods, technology, and industrial inputs. When the dollar weakens, imports become more expensive, feeding inflation again. This creates a feedback loop. Higher costs lead to pressure for higher wages and more government support. More spending leads to more deficits. More deficits weaken currency confidence further. None of this explodes overnight. It just grinds the system down slowly. Now consider the role of the Bank of Canada. Central banks walk a narrow path, raise rates too much, and you crush growth in households. Cut rates too early, and you risk inflation and currency weakness. Canada's situation is especially delicate because of household debt. Every decision feels constrained. Markets can sense that. When a central bank appears boxed in, its currency loses some of its defensive strength. The loonie is no longer seen as flexible. It's seen as vulnerable. Foreign investors also pay attention to political signals. Policy uncertainty matters. When energy policy feels conflicted, when taxation changes frequently, when major projects face endless delays, investors hesitate. Canada sends mixed messages. On one hand, it wants growth and investment. On the other, it adds layers of complexity that make execution difficult. That contradiction shows up in capital flows, and eventually in the currency. There's also the issue of national narrative. This may sound abstract, but it's powerful. Strong currencies belong to countries with a clear economic identity. The US is innovation and capital markets. Germany is manufacturing. Japan is precision and export discipline. China is scale and industrial power. Canada's identity has become blurry. Is it a resource giant? A green transition leader? A real estate economy? A services hub? When the story is unclear, the currency lacks a strong anchor. Meanwhile, everyday Canadians feel disconnected from these forces, but they experience the results directly. Vacations cost more. Imported electronics are pricier. Subscription services creep upward. Even online shopping feels heavier. These aren't dramatic shocks. They're lifestyle erosion. People adapt quietly, cutting small things here and there, not realizing they're adjusting to a weaker currency environment. Another underappreciated factor is demographics. Canada's population is aging. An older population tends to save more and spend less. That slows economic momentum. At the same time, supporting healthcare and social systems becomes more expensive. If productivity doesn't rise to offset this, the burden falls on borrowing. And borrowing, at scale, is never currency friendly. Then there's geopolitics. The world is becoming more divided, not more cooperative. Trade blocs are tightening. Strategic resources are being weaponized. Countries are prioritizing self-sufficiency. In this environment, middle powers like Canada must be extremely strategic to protect their economic relevance. But Canada often reacts instead of leads. Reaction is not rewarded in currency markets. Let's also address something uncomfortable. Canadians are culturally optimistic about institutions. There's a deep trust that systems will work it out. That optimism is admirable, but it can also delay necessary reforms. When problems are gradual, they're easier to ignore. But currency decline punishes delay. It compounds quietly. At this point, some people might say, but every country has problems. That's true. The difference is direction. Is the country correcting course or drifting? Is productivity rising or stalling? Is capital being attracted or tolerated? The Canadian dollar's recent behavior suggests markets see drift, not direction. This doesn't mean collapse is inevitable tomorrow. It means the path of least resistance is downward unless something changes. And meaningful change is hard. It requires political courage, structural reform, and honest conversations. Not slogans, not temporary relief, real decisions. As we move into the final part of this video, the most important question becomes personal. What does a slowly weakening currency mean for you? Not in theory, in daily life over the next 5, 10, 15 years? And more importantly, what signals should you watch so you're not caught off guard? A weakening currency doesn't announce itself with sirens. It shows up in subtle ways that feel normal at first. You adjust your expectations, you delay purchases, you accept that certain things are just more expensive now. Over time, that acceptance becomes permanent. This is how silent currency decline reshapes societies. Not through chaos, but through normalization. For Canadian households, the long-term impact is clear. Imported inflation becomes a constant companion. Even if domestic inflation looks under control, global prices still leak through. Retirement planning becomes harder. Savings lose international strength. Younger generations face higher costs with fewer opportunities for real wage growth. None of this feels dramatic in a single year. It feels heavy over decades. For businesses, a weaker dollar raises input costs and complicates planning. Some exporters benefit temporarily, but that advantage fades if productivity and scale don't improve. Meanwhile, companies relying on imported technology or components face shrinking margins. Investment decisions become cautious. Growth slows. The cycle reinforces itself. Nationally, influence matters too. Currency strength is power. It affects trade negotiations, global partnerships, and strategic flexibility. A country with a weakening currency must constantly compromise. It reacts more than it shapes. Over time, that changes how the world treats it. So what makes this time different for the Canadian dollar isn't one crisis. it's alignment. Debt, demographics, productivity stagnation, policy constraints, global competition, and capital behavior are all pointing in the same direction. That alignment didn't exist before, and reversing it requires more than optimism. The goal of this video isn't fear, it's awareness. Because awareness creates options. When you understand the forces at play, you stop being surprised. You ask better questions. You make more informed decisions about savings, careers, investments, and expectations. This is why conversations like this matter. And it's why Canada Global Economics Now exists. Not to predict disaster, but to explain trends early, calmly, and honestly, before they become unavoidable. If you've watched this far, I'd really like to hear your thoughts. Do you feel the Canadian dollar's impact in your daily life? Are prices, travel, or savings feeling different than a few years ago? Drop your thoughts in the comments. Your perspective helps others realize they're not alone in noticing these changes. If you found value in this video, share it with someone who cares about Canada, its future, but doesn't tend to usually think about currency. These conversations grow stronger when more people are involved. And if you want more clear, grounded analysis about Canada's economy in a changing world, make sure you're subscribed. Because the biggest economic shifts rarely arrive loudly. They arrive quietly, just like this one.